Herzlich willkommen zu einer neuen Folge. Marc spricht mit, heute Louis-Vincent Gave. Er ist der Experte, wenn es eigentlich um Emerging Markets geht, wenn es um Aktien geht aus Schwellenländern. Und er ist dafür absolut prädestiniert. Denn er ist ein Weltbürger. Er ist in Frankreich geboren, er lebt in Kanada, er hat in den USA studiert, hat ein Büro in Hongkong und beschäftigt sich seit vielen Jahren mit Investments in Schwellenländern. Und natürlich geht es auch um Rohstoffe. Also schnallt euch an, es ist wirklich ein sehr herausragendes Gespräch geworden. Ich bin überaus glücklich, dass wir ihn erstmalig exklusiv auf einem deutschsprachigen Kanal haben und dass er uns auch Insights gegeben hat, welche Aktien er jetzt interessant findet, wie er die aktuelle Situation sieht, was die Inflation macht, die Rezession und so weiter, wird den einen oder anderen überraschen. Und er gibt erstmalig auch wirklich wertvolle Investment-Tipps, wie man richtig Geld verdienen kann. Also, bist du bereit, um jetzt Geld zu verdienen, um in Emerging Markets oder Bitcoin und so weiter zu investieren? Wer Unterstützung, wer Hilfe braucht, der kann natürlich gerne auch schauen auf unserer Webseite friedrich-partner.de. Da bieten wir Honorarberatung an, maßgeschneiderte Strategien. Ja, also viel Spaß mit Louis. Welcome to a new episode, Deep Dive today with Louis-Vincent Gave. Hi, Louis.
Hello, thanks so much for having me.
Yeah, we're happy, we're honored actually, and today with my colleague Florian. And perhaps you, I think it's the first time you're on a German channel, isn't it?
I believe it is.
Wow. This is
the first time for everything, and I'm very excited that it's with you guys.
Yeah, we're too. Thank you very much. We're honored. So please introduce yourself to our audience.
Sure. So my name is Louis Gave. I'm born in France, raised in France, moved to the US for university, then basically moved to Asia started working for a French bank. They sent me out to Asia and I fell in love with the place. I've been living in and out of either Hong Kong, Singapore, or mainland China for the better part of the past 25 years. I started a business in Hong Kong called Gavekal. We're a macro research firm on the one hand and a money management firm on the other. We manage money mostly in Chinese fixed income, Asian equities, and global equities. And that's roughly who I am. When people call me, it's usually they want to discuss China, what's happening in Asia, since I've been there 25 years. But being French, I'm always happy to talk about what's happening in France. So hoping that we have a fun conversation, and feel free to take it wherever you want.
Perfect. Marvelous. Yeah, let's start perhaps with the big picture. Let's talk about macro. What's the outlook right now for the economy, geopolitics, and everything?
Just on that, we could talk an hour. But
look, you've got 1 minute. 1 minute.
Look,
no, just kidding.
I think there's three important questions. Two of them, I think, are well-beaten paths, and everybody will have made their own opinion by now. The first, of course, is whether the U.S. enters into a recession or not. The second is what's happening with China's recovery. I think we all had big hopes, myself included, that once China reopened, things would be off to the races. And so far, it's been a bit of a damn squid. So, however you fall on these two questions dictates your outlook. But for me, there's a third question that I think people are missing, and perhaps one of the more important developments that's unfolding, is that this. The Russia-Ukraine war, or the Russian invasion of Ukraine, has basically reordered the global cards. In that, you look at Russia; it's still an important economy. It's the biggest commodity exporter in the world, and Russia was organized to always export its commodities to Europe. For 200 years, Russia was facing west, and now Russia has no choice but to face east and south, and you're seeing a massive, I would say, realignment in the whole global south. You saw the Saudi-Iran peace deal. You're seeing massive capital spending, basically in an arc that goes from roughly Sebastopol to Jakarta. And, if you exclude China, that's 3 billion people where infrastructure spending is now going bananas. It's going bananas because the big constraint to infrastructure spending in that zone was always access to the dollar, because everything was always priced in dollars. Access to commodities was priced in dollars. And now all of a sudden that all these guys get access, if you're India, if you're Iran, if you're Saudi Arabia, etc. Now that you get access to commodities in your own currency, it changes everything. So I think there's a new boom unfolding. Basically, in that axis, you make a big crescent from Sebastopol to Jakarta that nobody looks at, because for the past 25 years, we've been trained to think growth in the world either comes from the US or comes from China. And if you don't get growth in either place, then you don't get growth. Well, maybe that's, I know, the most expensive words in our business, but maybe this time it is going to be different. And that you get a new axis of growth that again, nobody cares to look at because it's been such a dud area of the world for 30 years. So for me, those are the three questions: US recession or not, China recovery or not, and what kind of capital spending in the Sebastopol to Jakarta crescent.
So what's the answers for the two questions?
The first two, I actually don't think the U.S. will have a recession, and I know I'm in a minority at this stage because if you look at historical indicators, everything would seem to point to a U.S. recession, right? You have falling leading indicators, weak ISM surveys, the inverted yield curve. I mean, if you're playing recession bingo at home, it's pretty easy to say, okay, here we go. But I think, on the flip side, we're missing still a lot of things. U.S. corporates are still massively in positive cash flow. Usually they move into negative cash flow by the time you have a recession. Obviously, you have a very tight labor market, and I think that's a structural shift. You have governments that are still spending a ton of money, and this is for me the biggest quandary. Is you basically have full employment in the U.S. and a government that's running budget deficits of 6% of GDP. You also have two of the three biggest states, Florida and California, that are ramping up spending like crazy because both their governors are running for president. So, you look at all the government spending and you think, how do you get to a recession with that much stimulus still being thrown in? And then, you still have very tight corporate spread. So this is perhaps the biggest quandary and the hardest thing to get my head around and most people's head around is, on the one hand, you have a banking crisis. You have collapsing bank loans. And on the other, the best performing asset class this year in the US is CCC bonds, i.e. the crappiest of the crappy bonds that usually sell off well before you have a recession. So I tend to think the U.S. is a hyper financialized economy, and as long as financial conditions stay good, and they are still pretty decent, they'll avoid a recession. Not that I'm bullish the U.S. You still have all these issues. And the biggest issue right now is the uncertainty surrounding, of course, government spending and surrounding the debt ceiling. And whether the U.S. defaults or not in the coming weeks. Needless to say, a default would completely upend everything. So in my assumption there's going to be no recession, there's also an inherent assumption that there's not going to be any debt default. It's an assumption I'm getting more and more worried about. As the date gets closer, I start sweating about it. And on the Chinese recovery, I think we are seeing a recovery, actually. I think it's just very different than in the past. For the past 30 years, we've all been used to China booms being about real estate. And this time, it clearly isn't. It clearly isn't for a number of reasons that I'm happy to go into if it's of interest. But meanwhile, other parts of the economy are doing very well. Exports are absolutely booming in China.
So what are the reasons? What are the reasons?
Well, you're based in Stuttgart, right? You're not going to like this, but China is now the second. It's now the second largest auto exporter in the world. From nowhere, 5 years ago, people missed this because it occurred during the COVID crisis. But basically, China went from exporting about 300,000 cars a year to exporting 3.5 million cars a year, from just out of nowhere. Massive surge. This time next year, China will be the biggest car exporter in the world. Why? Because China's basically successfully done its transition to electric vehicles in a way that Germany hasn't, in a way that Korea hasn't. In a way that Japan hasn't, frankly. China is now exporting. Do you know BYD? It's the company that Warren Buffett is invested in. They now export a car called the Seagull. That's the name of the car. It's a little hatchback. Think of a little bit like a VW Golf or something. Full electric, 250-mile radius, 11,000 US dollars. So that's roughly 10,000 euros. And that car is just selling like hotcakes all across emerging markets. They've now started to export it to Australia, etc. So they've got an export market that's doing very well. I think China's basically taking over the entire global auto supply chain, which is massive. That's roughly, take any country, and it's typically a quarter of your industrial production for most big developed economies, whether Japan or Germany, US, etc. And China's just eating that up. So you've got that. And then you got a local consumer that is actually still doing very well, frankly, partly for demographic reasons. China's obviously getting older. It's much more urban, but it's also richer. And when these things happen, what you see is the country also becomes more single. Today, roughly 10%. So if you look at 10 years ago, 4% of Chinese women in their 30s were single. Today, it's almost 10%. In just 10 years, that's a massive shift. But if you contrast that to Korea, to Japan, to Singapore, to Hong Kong, i.e. richer societies, that's 30%. I'm going to guess that in Germany, you're probably at 30% or more of women in their 30s being single. And with that comes, as you get that shift from sort of below 5% to over 30, you get a dramatic shift in consumption patterns. More spending on cosmetics, more spending on luxury goods, more spending incidentally on housing, because as everybody becomes single, you need just more units, more apartments, more individual units, but less spending on things like cars. If you're a single person, you don't need a car. And more spending on things like tourism, much more spending on services than goods. And you're seeing all this in China today. I think this explains why, if you look at, for the past couple of years, things like LVMH and Hermes keep making new highs. Those are obvious plays on China. And things like BHP and Rio Tinto that are other plays on China, but different plays on China, are rolling over and faring poorly. I tend to think that the Chinese economic recovery will be pretty decent, but it'll be very different from what we've known in the past. So putting long-winded answer to your question, I think we're not going to get a US recession. People in the second half of this year are realizing that actually China's doing fine, and people are going to start waking up to the capital spending boom that's unfolding in infrastructure. So you put these three things together, and in the second half of this year, we're setting ourselves up for a big rebound in long-term bond yields, and potentially a rebound in commodity prices as well.
Louis, so many great points, and we want to dig into the investment side of things a bit later. Sure. Let's get first back to Russia and Ukraine situation, because you made a lot of great points that there's basically a Game of Thrones game going on in the world right now, and in Germany or in Europe in general, most people are unaware of that. And all we hear is Russia is done. We are winning. It's only a matter of time. And that's basically the mainstream German perspective on this. Can you please give us a different view on this? Maybe you spend a lot of time in Asia, a lot of time in China. How do they see the events unfolding? What's their perspective on this whole conflict?
Yeah, look, I don't know if Russia's winning or not. They say that, the first casualty in war is truth, right? I don't know if Ukraine is winning or not. It's the first casualty in war is truth. You hear so much from both sides. Who knows what's really going on? Here's what I do know is that unless there is regime change in Russia, which at this point seems unlikely to me, I think Russia, for Europe, for US, will be a no-go zone. It'll be like a North Korea, for all intents and purposes. It'll be a country that we completely freeze out. Whether some settlement happens in Ukraine, whether we have a ceasefire, whether, Russia will remain a sort of North Korea. Which means to me that, and North Korea is one thing, who cares? It's a tiny little country, right? But Russia, again, is the world's biggest commodity exporter. And so what we've done is, the end result of all this is, in essence, I think we've handed Russia on a platter to China.
And that's a big mistake, isn't it?
Well, maybe we didn't have a choice. We can debate this all day. I don't know if it's a mistake or not, or it just is. As far as I'm concerned, I'm an investor. I don't really spend time thinking about what the world should be like. I just think, okay, this is what the world is like and the consequences. Now, my starting point when I invest money is actually that economic activity is energy transformed. That, you want to get anything done, you need energy. And whoever has the cheapest cost of energy starts with a huge comparative advantage. It doesn't mean that they win, but they're doing pretty well. Now, if you look at period 2000 to 2011, China actually had the cheapest cost of electricity. Why? Because it burned 7 times over that 10 years period. It burned 7 times as much coal. Like it basically doubled its coal consumption sort of every 3 to 4 years. And China's coal use went parabolic. So it had a very cheap cost of electricity, of course, at the cost of its environment. So in 2011, China said, you know what, I'm done with coal. I can't see across the street. The air is disgusting. I have to stop. Logically, cost of production should have gone up around the world because China is such a big input. But we got lucky because we had the US shale revolution. And so the US became the world's cheapest electricity producer, thanks to all the natural gas that it found and the collapse in the price of natural gas. And the US had a 10-year boom. And after China outperformed everybody from 2000 to 2011, the US outperformed everybody from 2011 to 2021. Now, my hope as a European was that Europe was going to pick up the baton. That, with the Nord Stream pipelines, we too were going to get cheap gas. We too were going to get cheap energy, which would allow us to be competitive on a global scale. Of course, these hopes have been literally blown out of the water. And now Europe has basically cut itself off, or has been cut off, or however you want to look at it, from cheap commodities coming out of Russia. So this puts Europe now at a massive disadvantage. Meanwhile, if again, whoever has the cheapest cost of energy starts with a winning proposition, then today that's the global south. Why? Because the global south is okay dealing with Russia. Basically, at this stage, whoever agrees to buy energy from Russia buys energy 30% cheaper than everybody else and buys it in their own currency. And I don't say this, with joy in my heart. As a European, it saddens me. But the reality is that today, China, India, Thailand, South Korea, all these countries that are buying oil from Russia at a 30% discount in their own currency now have a massive comparative advantage relative to, say, Europe, where we now have to buy gas from Qatar or from the United States, which means first we have to earn the US dollars to do so. And then, so yeah, I think for me, the Ukraine-Russia war means that, it's a great comparative advantage that's been passed on to, what could broadly be called the global south, the Chinas, the Indias, the Thailands of this world.
Well, that's not a great outlook for Germany, because as we just learned, we can't earn our dollars anymore with selling cars because China takes this one from us. So I guess it's getting cold in Germany.
It's not. It is. No, in fairness, jokes aside, it is not a great outlook for Germany. Now, we've had something like this before in the 1970s, and the mantra in the So I'm French. The mantra in the 1970s in France was we don't have oil, but we have brains. And the idea behind that was we'll build a lot of nuclear, which we did in France. We built tons and tons of nuclear in the 1970s, and that carried us for the following 30 years. Unfortunately, we sort of let that slip, and a country like France had a massive comparative advantage in nuclear. But by the way, so did Germany. Germany also had a whole nuclear comparative advantage. But I would say that in an act of unprecedented domestic economic sabotage, because I can't call it anything else, we've decided as Westerners, as Western Europeans, to basically kill our nuclear comparative advantage. And I think we did so. It was hubris. We did so thinking, well, obviously the hope was we'll have wind, we'll have solar. And if that doesn't work, we always have the backstop of Russian gas, and and Russian gas is going to keep falling in price because there's so much of it, and we're going to help them exploit it, and so we'll have that backstop. Now that that backstop is gone, well, we're in deep trouble.
Yeah, we are. We are.
So I want to address 2 points. I want to talk to you about the US dollar and what's going on there. But let's stick with France for a moment, because just yesterday, France or the government announced another proposal to back up nuclear energy again. So they are going down a different route than Germany, a better one. And we also had Peter Sayan on the other day, and his outlook on France was actually also quite positive. So as somebody who knows the country very well, what's your take on this? We see a lot of demonstrations and riots in Paris and France. So there's a lot of trouble on the other side. But yeah, what's your take on the current situation and the outlook for this decade?
Well, so on the energy front, on the nuclear side, I would say better late than never. The funny thing is when Macron was finance minister for Hollande, he was basically at the forefront of dismantling the French energy industry. Selling all our best technology to General Electric. And then when he ran as president the first time around, he ran on a very anti-nuclear platform, partly to cozy up to the Greens in France. And then, of course, this last election that he ran last year, between now and then you'd had the Russia invasion of Ukraine. So now all of a sudden you change his stripes, because all of a sudden nuclear was now about geopolitical independence. It became a necessity. So at least he had the smartness of thinking, okay, the facts have changed. I need to change my mind. The facts on the ground have changed. I can no longer rely on cheap Russian gas. Okay, I got to get back to nuclear. But it's not something that you can turn on like this. It's not like, oh, we have all this oil, we weren't drilling it, but now let's drill it and it'll be here in a year and a half. Building nuclear plants takes a lot of time. Training nuclear engineers takes a lot of time. And that's perhaps the biggest challenge we have in France today. And that is that we've really spent the past 10, 15 years telling people we're moving away from nuclear. So imagine you're a smart, young 20-year-old engineer. Why on earth would you go into the nuclear sector? Right? The government is telling you we're shutting this down. So we haven't trained nuclear engineers for 10 or 15 years. Now we're saying, okay, we're going to train them, but it's almost like you're starting from scratch again. Because, a lot of this knowledge is passed on from generation to generation, etc. So you skip a generation and you've got big trouble. So I think that the challenge is there. We're addressing it. And hopefully, again, we don't have oil, but we've got brains. And I do think we have brains in France. We do train a lot of engineers. We have great engineering schools. So we've set up ourselves a challenge, but I think we can rise to it. I'm hopeful, but I'm not, I'm also acknowledging that it is going to be a genuine challenge. And let's not kid ourselves that it's going to happen quickly, because it won't. Here's a fun fact for you. Half of the world's nuclear engineers today are trained in India. It's now incidentally, perhaps that's another option. We go to India and we hire a bunch of them, and we bring them over here because we don't have them anymore. And not the other half, but another third are trained in China. So that really narrows the scope down. Now on the riots. It's as a Frenchman, I look at this and it's really distressing, right? But it is. It's really, you look at most countries in Europe, whether Germany, Sweden, etc. Look at the underlying demographic reality, and they say, look, we are aging, we are. So not only are we aging, we're living much longer. So we're getting more people who live longer. That's a reality. So how do we, as a nation, decide to deal with this reality? And there's only two options. Either we cut benefits to old people massively, or we work longer. I mean, it's pretty simple maths. And the fact that we're incapable of having this honest discussion in France, that our trade unions block this kind of discussion is. Yeah, it's depressing. It's the depressing bit, I think, is that actually a lot of people understand this. but it's a very vocal but decent-sized minority that can block a lot of things. And here I think part of overlaid into all of this is the fact that Macron as a leader is probably the wrong guy to push for this reform because he's just hated and not liked. I think this reform should have been done in a completely different way. You should have first had a big national debate, and then you should have had a referendum. And then if people vote for the reform, then the minority can't block it. Unfortunately, he tried to push it through Parliament with basically national emergency procedures, which incidentally turned a lot of people against the very reform because if you think, okay, we use this national emergency measure to push this when it is not a national emergency. It's a national emergency over the next 20 years, but it's not a national emergency today. This measure is for when Germany invades us. It's not for when you want to push a reform. So to push using that, to be honest, it turns people like me against it because you're like, well, that creates a terrible precedent. And then if you're going to use it for that, then you can use it for anything. So anyway, he's done a complete hash of things, which is, again, as a Frenchman, very depressing.
Yeah, you mentioned that some countries already buy commodities or oil or gas in other currencies, in their own currency, in ruble and in renminbi. So do we see the end of the world reserve currency of the US dollar? Because more and more countries like the BRIC states, for example, turn away from the dollar.
Yeah, look, I think for me, when the U.S. said to Russia, well, you're cut off from the U.S. dollar system, the U.S. cut its nose to spite its face. It was a very short-sighted measure. It's one thing to cut off Iran or cut off Venezuela, but to cut off the world's largest commodity exporter and tell the world's largest commodity exporter you can't use dollars was a sign of hubris by the U.S. But not that I'm a fan of Russia or anything, but I think the view was, well, we cut them off the dollar, their economy is going to crumble. When it was pretty obvious that Russia was going to say, well, if I can't sell it in dollars, then I'll sell it in something else. I mean, I don't think you need to be Einstein to figure that one out. That was always the path Russia was going to go. And so having done that, I don't know how you put that genie back into the box. Now that oil is priced in other currencies, but the dollar, Russia's never going to go back to using dollars again. Perhaps unless you have regime change in Russia, but China is never going to go back to using dollars either. I'll give you an example. BHP, the big Australian mining giant, announced a couple months ago that they were now doing deals for iron ore in renminbi. Now, BHP doesn't need iron ore, doesn't need renminbi per se, right? They don't have really operations in China. They don't run mines in China, so they don't need renminbi. But what China told BHP is they said, look, we love your iron ore. It's so much better than this crap we buy from Russia. But Russia, we pay for it in renminbi. So unless you accept renminbi as well, which is going to buy more from Russia and less from you. And so BHP says, okay, fine, I'll take renminbi. And now that BHP accepts renminbi, China's going to Anglo American, to Rio Tinto, to Vale, and saying, oh, by the way, BHP accepts renminbi, so if you don't, we're going to do more with BHP and less with you. And so now what do you see? You see Lula come up to China and saying, oh, we're going to do more in renminbi as well, and Vale is going to trade in renminbi as well. And again, like once all that is done, I don't think you walk it back. Unless, of course, you have an economic crisis of epic proportions in China. Something where China completely blows up, and then everybody at once says, okay, I don't take renminbi, or China just stops buying iron ore altogether. So unless you have an economic crisis of epic proportions in China, I think that the trend is set where from now on, people are gradually and slowly going to keep moving away from the US dollar.
I guess we agree with all of that, but we also wonder where this is going. Because when I imagine I'm a commodity producer in Brazil, do I really trust the Chinese more than the US? Do I really want to have my savings in renminbi instead of US dollars? So actually, I don't see how another fiat currency can really take over the US dollar unless you bring oil or gold into the equation. Do you agree, or do you think actually that we have a multipolar world reserve currency world?
Yeah. To your point on will people trust China? I guess it all depends who you are, right? If you're Germany, no. If you're Germany, you're always going to trust the US more than you trust China. If you're Qatar, if you're, Saudi Arabia, it might be a push at this point. It might be a case of, the U.S. has been threatening me for years and years to, if I don't do as they want over invading Iraq, if I don't do as they want over the 9/11 Commission, etc., to confiscate my assets, and now they've just done it to Russia. If I'm a non-democratic country, it might be a push. But to your point, I think one key difference, one important development that has unfolded in the past few years is that, of course, China's opened up its own gold market in Shanghai and so there's now an RMB gold window. So you can earn the renminbi. You can use these RMB to buy goods made in China. On the one hand, you can use these RMBs to buy Chinese government bonds whose long-term returns is actually much better than that of U.S. Treasuries, less volatile and stronger returns than U.S. Treasuries. Or if you don't trust any of that, you can buy gold and trade it back into gold. And so to your point, I think you're going to see more and more of that. And depending on where geopolitical tensions are, gold will fluctuate in consequence. But all this points towards a structural bull market in gold for sure. Not that I'm a big gold bug. I actually don't really like gold as an idea, but you have to acknowledge when the trends are strong, and we're in a bull market for gold.
Two questions. Actually, you just mentioned the Shanghai Gold Exchange. I assume most people in Germany are unaware of what's going on there. Can you give us just the very quick elevator pitch on the Shanghai?
It's basically it's China a few years back said, look, we're creating our Shanghai Gold Exchange, and we've got a window open at all times where you can change renminbi for gold. Now, most people don't know this, but China is actually the world's biggest gold producer. China produces more gold than any other country year in, year out. China is also one of the biggest gold importers. On any given year, it's either China or India that's the biggest gold importer in the world. And in India, most of the gold is imported by private people. In China, a lot of the gold is imported actually by the government. And so, it's a big unknown what China's gold reserves are. But in essence, I do tend to believe that, China is now sort of managing the renminbi partly against gold. And you see the RMB gold price has been, decently stable over fairly long periods, which is a way for China to promote trade, not with Europe, not with the US, but to promote trade with, I would say, the global South again. Because, in Germany, nobody cares about gold anymore. In the US, nobody cares about gold. But in India, in Pakistan, in Russia, in Indonesia, in Thailand, in all these countries, gold is still a very important part of the culture, of the financial stability of people all the way up from the top of the government all the way to people in the street. And so, sending a signal and saying, look, our currency is going to stay, we're keeping purchasing power against gold is a very powerful signal, and I think is one of the reasons why the Chinese government bond market has actually outperformed the U.S. Treasury market by meaningful amounts. And when I say meaningful, by over 15-20%, depending on where you are on the yield curve over the past 10 years.
Thanks for that. So just to sum it up, basically, as a Brazilian commodity exporter, I don't have to trust the Chinese not to devalue the renminbi. I just can bring my renminbis to the Shanghai Gold Exchange and can actually exchange my surplus against gold. And that gives me a huge benefit compared to just holding renminbi. So that's a huge development there. And that's something I guess we have to pay close attention to over the coming years. should we actually switch to the portfolio part?
Yes. I would like to switch to the investment side of things here. So let's talk about some investment ideas, and let's talk about commodities and everything else. So the world is going definitely through the biggest change or shift in the last 80 to 100 years. We see a new cycle. So what does that all mean for investing, for building portfolios? Recently, you stated the days are over where you bought 60% stocks and 40% bonds. What do you mean by that, and what does it mean for investors?
Yeah, well, to be honest, that was the big theme of my book that I published a couple years ago called Avoiding the Punch. So I'm plugging my book here. But
yeah, we'll put a link beneath the video in the show notes.
That's
definitely.
Awesome. But look, here's the big question mark every investor should ask themselves. And the question mark is whether the inflation surge that we've seen over the past couple of years is just a temporary phenomena, transitory, to use the word that central bankers used, or does it mark a structural shift? Now, I'm of the firm belief that it marks a structural shift. And this is both for policy reasons and for just changes that we're seeing in our world. The first important change, of course, is the rapid shifts in our demographic profiles, where all of a sudden we're running out of workers. And this is a story you're seeing everywhere, in Germany, in France, in the US, in China. And it's actually perhaps more pronounced in China. China, for all of my career, used to add 10 to 15 million workers, highly motivated, hardworking workers, 10 to 15 million coming onto the global landscape every year. And that's no longer the case. And so labor costs are going up everywhere in the world. So that's number one. I think we've lived in a world for 35 years where capital was always rewarded at the expense of workers. I don't want to sound like a Marxist, because I'm not, but capital got all the rewards and workers got none. This is now over. Workers are now getting the rewards. The fastest wage growth is actually happening at the very lowest end of wages, right? It's the lower end wage earners that are now seeing the biggest pickup in growth, which of course then has an immediate impact on economic growth, because people at the low end consume much more than people at the high end. So that's one important structural shift. Another important structural shift, of course, is the new Cold War, this view that we need to reindustrialize in the Western world, etc. Another third important shift is what we've called in our research greenflation. Our desire to go through an energy transition, which is a very costly exercise. The whole story of capitalism for the past 200 years was always to go towards cheaper and more efficient sources of energy. So we start with burning wood, then we move to whale oil, then we have coal, and we have oil, and we have natural gas, and then we have nuclear. Each time we get cheaper and cheaper and more efficient. And now, by government decree, we're saying, okay, well, screw all that. Put that aside. We're now going to more expensive and less efficient, which is fine.
Makes sense.
Yeah, makes sense, of course. But if and by the way, Germany is in the forefront of this.
Champions again,
and
number one again.
Yes.
Yeah.
So if let's not kid ourselves that there's not an economic cost to this, and the economic cost is through higher inflation. And it's because that's how you spread a cost. Inflation is how you spread a cost across the economy. And note, I haven't even talked about crazy fiscal policies or crazy monetary policies yet, just as the structural shift. So if, like me, you do believe we're now in a structural inflation phase, then the first obvious consequence is that bonds and equities are no longer negatively correlated. It's a well-known thing in markets that there is no free lunch, right? But if there is one free lunch, the one free lunch is actually portfolio diversification. Is actually the ability to reduce risk by spreading your risk across different asset classes. And that works amazingly well in deflationary environments. And it worked great for 30 years, and it has now ended. The correlation of equities to bonds is now 1-for-1. Now, the other big rule, of course, in in financial markets is that over the long term, you want to be an owner. Over the long term, you want to be an equity holder. So you want to find the companies that you like. You want to, companies that have good prospects, companies that have strong growth profiles, and you own these companies. The question is, how do you diversify your risk? How do owning the equities? I think that bit remains pretty simple. It's the same as it ever was. The new question mark is, how do I diversify the risk from my equities? Knowing that bonds no longer do the trick. Now, for me, the most obvious answer, and it worked very well last year, the most obvious answer is that in an inflationary environment, your big risk is not that interest rates go up, because inflation can eat up the interest rates. The big risk is that energy prices spike. When energy prices spike is when you get crushed on equities in inflationary environments. This is what you throw through the 1970s. So the way you hedge equity today is either you own energy or you own precious metals, because precious metals are basically just stored energy. Getting gold out of the ground, about half the cost of that is energy. But the most efficient hedge for portfolios today is energy. So you can do this either by owning long-dated calls on oil, or you can do this by owning energy producers. But so it's a very different portfolio structure, and it is a portfolio where you end up inherently with a higher volatility, and you just have to learn to accept that. And that's tough, of course, for older people. When you're young, you can accept higher volatility. When you're older, it becomes tougher. But so your whole portfolio construction exercise has been turned on its head, where you're one of the riskiest asset class out there, namely energy, is actually now your portfolio stabilization. And again, you saw this in 2022. If you made money in 2022, it's because you were long energy. If you were not long energy in 2022, you couldn't make money.
Absolutely true. But so far in 2023, it isn't working.
Yeah.
But the
equities are.
Yeah,
so again, in terms of portfolio diversification, I think it still works in that, okay, I'm making money on equities, but my energy isn't working, but that's okay. I'm making money on equities. So they remain negatively correlated, which is what you want.
That's a very good point. Just to go back to energy, as you're probably aware of, most people in Germany have little to non-exposure to energy stocks. For somebody who's watching this, who doesn't own any energy stocks, do you have any advice for him how to actually build up an energy portfolio? Would you buy only oil equities? Would you go into gas? Would you go into coal? Any advice from your side?
Absolutely. So the way I look at energy, to be honest, is think of a pyramid. And the bottom of your pyramid is your dirtiest energy, the coal that you just mentioned, or even the oil. And especially things maybe like tar sand oil in Canada or things like this. And as you move up the energy time frame, you get cleaner and cleaner. And at the very top, you have your wind, your solar, etc. Now, the reality is the valuations between the bottom of the pyramid and the top are polar opposite. At the bottom of the pyramid, you can buy coal miners for 1.5 times EBITDA. You take Peabody Energy in the US, it's a $3 billion market cap. They just announced 1.3 billion share buybacks, and the market doesn't care. They're just reducing their market cap by a third, and the market just doesn't care, because most people can't even own it. ESG mandates and etc. And of course, everybody wants to own the top of the energy pyramid. And the top of the energy pyramid, because it is very richly valued, tends to be much more correlated to the broader equity markets. And the bottom is a lot less correlated. So I would tend to think that a lot of the opportunity set is in the bottom. Look, as a capital allocator, my comparative advantage is, I think one of my comparative advantage has to be able to bring capital to places where other people aren't willing to give capital. Today, everybody in the world is willing to buy Microsoft, and everybody in the world is willing to buy, Apple, etc. So what's my comparative advantage in providing capital to these guys? I think it's pretty limited. But nobody in the world's willing to give money to coal miners. So that perhaps my returns over the long term are going to be both negatively correlated, or at least uncorrelated, and disproportionately big. So I think that's one way to do it. I would add one thing though, is that whenever you invest in energy, there's always a big political risk. For some reason, Apple can make as much money as it wants, and Pfizer can make as much money as it wants. But as soon as energy companies start to make money, then policymakers come down and says, or people in the street says, this is a disgrace. Why are energy companies allowed to make money? We should have special taxes on them. Now, this is much more prone to happen in places like Europe or frankly emerging markets than in the US or Canada. In the US or Canada, I think the energy companies have done a decent job lobbying and buying a lot of policymakers to make sure that this doesn't happen. And so, I think the risks of special taxes on outsized energy profits in the US or Canada is much smaller than anywhere else in the world. So I like to buy my energy stocks there.
That makes totally sense. Actually, it's very funny that they delisted their only coal equity ETF before the big run started.
Well, that's fairly typical.
How it always works in financial markets. Just a quick follow-up on the Texas stuff. How do you think about investing into the commodity or the producer? So if you're worried about taxes, some other regulation, you could also only buy our oil ETF or a nat gas ETF. How do you think about that?
Yeah, so I think the oil ETFs and the nat gas ETFs are actually somewhat dangerous propositions. You're going to be very careful and do a lot of research on what you're buying because, to be honest, these guys, especially if the ETF is big, they sort of become a mark because everybody knows what they're doing, and they need to roll over a contract every month, and everybody knows when they need to roll over the contract. So they become a sort of mark for traders in the market. And so any fund for me that needs to basically roll over contracts is potentially dangerous. And I would say here, I know there's a big natural gas ETF in the US that people like to trade. But that natural gas ETF, you would think, it would own the entire curve of contracts, but actually it only owns the front of the curve. And the front of the curve is so volatile because sometimes there's too much gas, and because gas is so hard to store, the price of gas at the short end can absolutely plummet. So, that natural gas contract can conceptually go to zero. So the ETF can conceptually go to zero. And you've seen this, of course, with the USO in the US when you had the massive dislocations during COVID. The USO ETF in the US basically was wiped out. So I'm always very wary. I think if you want to own commodities directly, you're better off doing it through the futures market and just owning the curve. Because if you're doing it through an ETF, you're going to be concentrating on one part of the curve, and every trader is going to be picking the pocket of your ETF.
Makes sense. Last question from my side to energy. What do you think about the whole oil service sector? We saw a huge underinvestment over the last decade because of ESG and government regulation in oil and gas exploration. And I assume that needs to change, especially if we lose the Russia supply in the West. What are your thoughts?
Yeah, it's been my cross to bear. I've lost more money in that sector than I care to disclose. Yes, indeed, you look at the supply-demand situation and you think, okay, we're going to need a capex spending boom. The reality is the capex spending boom is just not happening. It just isn't. Obviously, Russia isn't doing any more capex. Saudi Arabia is doing some, but really not that much. In the US, you're seeing fairly little as well. So far it's been, unexciting.
Very disappointing.
Very disappointing, unexciting. Having said that, it's. I think capex in the energy industry is a little bit like water turning into ice, right? It's like, water is warm at 20 degrees, and it goes down to 15, 10, 5, 10, nothing happens. And then at 0, suddenly it turns into ice. And so nothing happens in capex, nothing happens, and all of a sudden things surge. Now I own, for example, some of the offshore rigs, the rig providers. And those guys, went nowhere for a while, and then they bounced. Now they've been going nowhere for 6 months. But I look at these guys, and already they're getting huge prices for their rigs, and they're getting, they're making proper margins now. So now I'm much more comfortable owning these things. Even though they're going nowhere, I know they're generating huge cash flows. So when I own a company that's generating huge cash flows, even if the market doesn't appreciate the company, I don't stress about it, because at some point I think these cash flows either will come back into my pocket through share buybacks or through a management buyout or through something. It's just delayed gratification in essence. At some point it will work, at some point you will see the big capital spending plans, and these things will go bananas. In the meantime, I'm paid to wait. So I think for a while, the setup in oil service companies was pretty poor. I think the setup now in a lot of these guys is actually a lot better.
Cool. Just a quick question. Are you allowed, or are you happy to share any stock names, or you just want to talk about the sector?
Sure. I'm happy to talk about the sector. I mean, the name I own in the offshore rigs is RIG. It's RIG.
It's translation.
But there's lots of great ones. To be honest, I don't own a number of them, but they're all correlated at the end of the day. The subseas.
But I guess Transocean gives you a huge leverage if this thesis plays out.
Exactly.
Like you might expect.
But you have others, like Subsea is great, etc. There's lots of great companies in the space. I just happen to own that one. In the coal space, I own Peabody because it's a cash flow generating machine at this point.
But with the shitty management, or?
Yeah, but I think they're now, they're doing massive share buybacks. So
they're getting around.
I think they're coming around. Also in the energy sort of service space, I own a company that recently IPO'd called Atlas. It used to be called Atlas Sands, but it's not called Atlas Energy. It's AESI. It's a smaller company, but they're basically, to frack, you need sand. And so to produce more oil out of the Permian, you need a lot more sand. Now, sand used to be brought down from Wisconsin in trains. This company set up in the desert outside the Permian, and they basically have all the sand rights for the Permian. And so they're really well positioned. They got a much cheaper cost of sand than anybody else, and their business is growing leaps and bounds. So there's interesting things to do here and there.
Yeah. What's your take on Australian coal miners? They have really high dividends, so like 7, 10, 15%, even 20%.
New Hope and Whitehaven, for example.
So I missed that one. I looked at them. To be honest, they surged and they did great, and I did not participate, and I'm angry about it. And I didn't participate because of, to be honest, going back to this politics thing, Australia was one of these countries that in the previous commodity boom put in massive taxes on commodity producers, and so that gave me cold feet. I said, all right, they've done it once, they could easily do it again on these guys, and
they are still discussing it. So
it is part of the discussion there. So I just thought, no, I don't want to do it. But so I missed the big bull market. So that's on me.
And maybe there is another one coming. But any Canadian or American net gas names you're looking at? Or you find interesting?
I own a name in Canada called Tourmaline Oil, and the ticker's TOU. You were talking about how the Peabody management is widely panned in the industry. I think that the Tourmaline Oil management is basically seen as the gold star in the space. which, to be honest, you've needed to be in Canada to survive, both the energy price downturn, the cancellation of the Keystone pipelines, the a federal government that hasn't been not been very favorable to energy, etc. And they've managed to work their way through.
Thank you very much for sharing so many names with us and the audience. I think it's highly appreciated. So,
let's switch to emerging markets,
let's stick with commodities for a second. Any other commodities you're positive on for the foreseeable future?
I'm fairly consensus in that I also like copper. The reality is, if we're going to go through the energy transition, the copper, we're going to need more copper, and our capacity of production today in the world just isn't there, right? So there's that. I own China Moly, the big Chinese rare earth guy, or CMMC or whatever it's called now. It's I think at this point, but again, for me the big question mark is this, and I'm very nervous about it because it hasn't gone my way at all this year. But again, if I think the market is missing the massive capital spending boom that's going, as I mentioned, in that big crescent. And if I'm right about this, if we are going to see the building of telecom lines, of railway links, of new ports, of new pipelines in that whole area, the demand for copper, the demand even for things like iron ore, which is down in the dumps today, is going to be enormous. So, I own Anglo American. I own, as I just mentioned, CMMC, which is a Copper Mountain Mining Corporation in Canada, Antofagasta in Chile. These kinds of things. I think they've been negatively impacted by the fear of U.S. recession, and I think that the potential for a big rebound in a lot of these names in the second half is quite strong. And at this point, you can almost throw a dartboard at your commodity space, and it doesn't really matter where you're going to where it ends up landing. I think you'll end up broadly okay.
You mentioned earlier that nobody in Germany or in Europe cares about gold anymore. We are working hard to change that. So what about the precious metals miners?
Well, actually, so the precious metals is the one interesting one, right? Because all the commodities have been in the dump all year, except for the precious metals, where with gold sort of knocking on the door of breaking out to new all-time highs in U.S. dollar terms. In other currency terms, it's mostly broken out to new all-time highs. If you look in yen, if you look in Korean won. And what's going to change that? For me, precious metals, I've written a number of pieces on this over the years, but for me, precious metals are actually, most people think, oh, well, you buy them as a hedge against inflation and you buy them as a hedge against geopolitical risk, etc. But the reality is that for me, they're actually a derivative play on emerging markets, in that if you look at where the final demand for gold comes from in the world, it comes from China, it comes from India, it comes from the Middle East, it comes from Russia, it comes from Southeast Asia. These are the places where all the physical gold in the world is going. These are actually the guys making the market. So when these guys are thriving, as they were from 2000 to 2011, roughly, gold goes parabolic. And when these guys struggle, then gold goes nowhere. And these guys, have struggled. Now, I tend to think we're in a balance sheet expansion phase now in emerging markets. Chinese banks are back to expanding their loans. The Chinese, after 3 years of flatlining, Chinese monetary base and Chinese broad monetary aggregates is now back to expanding rapidly because the government is stimulating. India is also stimulating. We're entering into an election phase, period, etc. So we've just had over the past year a number of emerging markets hit the wall. Famously last year, Sri Lanka, Pakistan. When these countries hit the wall, your local entrepreneur has no choice but to sell gold to get money to, carry his business over. If I'm right that we're entering into a new emerging market boom, and especially a boom in that crescent, which is basically the gold consuming crescent of emerging markets, then gold will head much, much higher.
What's your goal with gold?
What's my goal with gold? What's my target price? A lot.
Yeah.
I'm sure you know the old story of an ounce of gold through history. If you wanted to clothe yourself well at the high end, buy a fine man's suit and a fine man's pair of shoes, that was an ounce of gold through history. What's a fine man's suit and a fine man's pair of shoes today? And I think a fine man's pair of shoes now, like a good pair, you want to buy a pair of Churches or something, it's going to be $700, $800, and a nice suit and a nice shirt and a nice tie is going to be at least $3,000. So let's call it $4,000 for a nice to dress a man, nicely.
No underwear?
Exactly. Well, I throw in the underwear for free.
No socks? What's going on, Louis? French men again.
I don't wear underwear.
Espadrillos.
Yeah, no, you're right. So I think you'd like to dress a nice man. You're talking $4,000, like a fine suit. So it can at least double from here. And that's if you assume it doesn't overshoot.
Interesting.
And that is, you assumes the price of the suits and the price of the shoes also doesn't go up, which is not a given.
Perfect.
It's not a given.
Yeah. So, what would you choose, silver or gold? What's your favorite? Because you said you don't like gold, so I guess you like silver more.
I do not dislike gold. I just said it's going to $4,000. I mean, it's at $2,000 today. That's not like disliking all that much. Silver is obviously always more industrial, and I actually think people are too negative on growth, and especially too negative on growth. People are too focused on the U.S. and saying, "Oh, the U.S. isn't doing great," etc. But if you look at global PMIs, the global PMIs now had 3 months in a row. It was below 50 5 months ago, and you've now had 3 consecutive months above 50 and accelerating. So, long-winded answer: I like silver better than gold. Because of this industrial element, and because I think people are too negative on global growth, and silver. And again, if we're going to do this energy transition and going to have electric cars and do all these things, the demand for silver is also the demand for copper is going to be enormous. The demand for silver is going to be enormous as well. So, long-winded answer: I like silver better than gold, but I like both.
Okay, perfect. So, like you are, we are also emerging market bulls, and let's talk about emerging markets. Where are the opportunities? We have better demographics, we have better growth, we have more hunger for success, for prosperity, and so on. So, how would you invest into emerging markets? And which countries? You already mentioned actually which area you like the most, but what about Brazil? What about Mexico, for example? What about Indonesia and so on? Which are your favorite countries?
Yeah, so you mentioned demographics, and if you go back to the origin of the term emerging markets, it was invented by Fidelity in the 1970s to basically lob together a bunch of countries that actually had fairly little in common except a good demographic structure. Like lots of young people and not so many old people at the top. And even now, by now, you look at this so-called emerging markets, they don't even have that in common anymore, right? China has a horrible demographic structure. India has a good one. It's like, it's all over the place. But what they do have in common is typically faster rising incomes. And what they still mostly have in common, most of them, not all, is, I would say, underutilized labor forces. Massively underutilized labor forces. And again, I think we're moving into a world where after 35 years of capital benefiting over labor, now all of a sudden labor is benefiting over capital. So it means that anybody who's got excess labor now stands to benefit greatly in the world. And who is that? That's Indonesia, that's India, that's the Philippines, that's Brazil, that's Mexico. These are all places with highly underutilized labor that can be brought on stream decently quickly. And that will benefit a lot. So I'm extremely bullish on all these countries that I just mentioned. Now, so that's the first point on emerging markets. For me, the second point, and I've mentioned this earlier, but it's access to energy and access to cheap energy. And here at this stage, the interesting thing is you have the emerging markets that produce energy themselves. Your Brazils, your Colombias, even your Mexicos, even if Mexico's production is going down fast. So I think, I'm a big bull on energy. So it's hard to not be bullish on the guys who produce the energy. Meanwhile, of course, historically, if you think, energy prices are going up, you'd want to avoid places like India. You want to avoid places like Thailand. You want to avoid places like Indonesia. But now all of a sudden, these guys get to get cheap energy from Russia and again pay for it in their own currency. So that's a game changer. And as the market realizes that's what's unfolding, you could have a structural re-rating of a lot of these places because the foreign trade constraint for these guys just basically disappears. So that's your second, I think, massive development. And the third massive development for a lot of emerging markets is that, the big problem for a country like Vietnam or India or Indonesia or wherever else was first access to capital, second access to energy, and third really access to having the ability to industrialize. Because it's hard. You need to build power plants, you need to build ports, you need to build railways, telecom lines. And you need to do this efficiently and for all of this to work together for you to be able to modernize. And this is the most important development for emerging markets is you now have China coming in and saying, hey, I'll do this for you. I did it for myself. I can do it for you. I can do it cheaply and I can do it on credit. And meanwhile, if you're a policymaker in Indonesia or in the Philippines or wherever else, the pressure is now on you. Everybody can see what China's achieved. And so if you're the president of Indonesia, the onus is now on you to deliver what China has delivered. And you have to deliver that at least as much or at least, go in that direction. So your whole incentive is to turn to China and say, okay, fine, I know I need to do this. Otherwise, the people are going to be pissed at me and I'm not going to get reelected. Help me do this. And so China comes in and does it. Now, when Xi Jinping started this big Belt and Road plan 10 years ago, everybody said, but these countries, who cares? They're rounding errors. Who cares? They're never going to be real export markets, etc. And I talked earlier about how Chinese exports are very strong, partly because of autos, etc. Chinese exports, if you take up all the countries that signed up to the Belt and Road initiative of China now exports more to these countries than it does to the United States. So China's created a whole new export market, mostly for things like earth-moving equipment and automobiles and telecom lines. And so these countries are, again, getting to modernize very quickly and very cheaply. And it's always quite striking to me when you visit some of these places at how quickly they're industrializing. I have a very close friend of mine who's been an African equity portfolio manager, which has not been a happy place to be for the past 10 years, but he's been an African equity portfolio manager. And he always tells me that, China's infrastructure spending has done more for African infrastructure than 70 years of Western aid. You now see the roads, you now see the railways, you now see the mines, you now see the telecom lines. And of course, China is not doing it out of the kindness of its heart. China is doing it because the history of every empire is to build roads. And you build roads to bring in commodities cheaper to the heart of the empire and push out finished goods to the outer realms of the empire, how you value finished goods. It's why in Europe we say all roads lead to Rome. That's what empires do, build roads. That's what China's doing. So it's not doing it out of kindness of its heart, but it's a massive development. So I would say, to long-winded answer to your question, but who's going to benefit? Whoever produces energy, whoever's participating in the Belt and Road Initiative, and whoever is de-dollarizing its commodity trade. Those would be the places I'd be eager to deploy capital in.
As we mentioned before, we had Peter Sign on the other day, and he actually made quite a contrarian case to yours on China. But in your opinion, China is cheaply valued. They probably won't invade Taiwan. I think you agree on this. So you investing into China hand over first? Or
yeah, look, I think Peter's made the opposite case for 20 years, right, on China. China's been blowing up for 20 years and was going to separate into 20 different countries and etc. Partly because it is, China's long-term history of blowing up and getting back together and blowing up and getting back together, which is why the Chinese Communist Party is so jealous of its power and monopolizing of the power in the center and preventing, local authorities, mayors, regions, etc., from having too much autonomy. Look, yeah, China today, I actually don't think China is the most exciting part of the emerging market space. I think there's, for all the reasons we highlighted, there's more exciting parts. But
which are the top three, like the top three most exciting parts right now?
Like I've been an Indonesia bull forever, and I remain so. I think actually most of ASEAN today is doing a great job in sort of balancing the sort of U.S.-China tensions and playing one against the other. I think that, the broader ASEAN is actually doing this decently well. They're benefiting from China's rise, while also staying friendly with the U.S. Now you could say, well, that's not a long-lasting proposition, but for now they seem to be doing a good job of it. I'm very bullish on Mexico. I think that the currency is undervalued, and the place is absolutely booming, and they're obviously the biggest beneficiary of the whole reshoring or friendshoring or whatever you want to call it. So I'm a big fan of Mexico, and look, I think the broader Middle East is about to go through a massive peace dividend. The end of the Saudi-Iran tensions, I think, is a game changer. It's a game changer because when you look at a map of Eurasia, Iran was sort of a big black hole in the middle, which was sort of blocking all sorts of channels of communications. Now that Iran basically joins the civilized world again, you can have pipelines that basically go from Saudi Arabia or from Qatar basically into China, so they can go that way, or they can go from Russia into India and they can go that way. So you're going to have a crisscrossing of capital spending that comes through Iran, and that benefits all the people that are on the other side and who were always forced to either turn west or turn east because they didn't have a choice. So there's lots of good stories out there, and this isn't to say that China's a bad story. I just don't think China's the most exciting story of the next 10 years. I am a bull on China. I own Alibaba, I own Tencent, I own Baidu. I think these stocks have been beaten up for a number of reasons, very cogent reasons, and are now basically being offered at very attractive valuations while offering very attractive growth prospects for the future. So I think there's some good companies to own in China that will deliver superior shareholder returns. But in terms of macro story, there's more exciting things than China right now.
Interesting. Last but not least, for somebody who's watching this again, and maybe if you're lucky in Germany, you have like 3 to 4, 5% maybe of your portfolio in emerging markets. So first, you would argue or advise to actually overweight probably emerging markets. And second, how would you go about building up your emerging market portfolio? Would you just buy an emerging market ETF? Would you buy an ETF for Mexico, for Indonesia, or would you actually try to select sectors and stock pick in those countries?
I think it really depends who you are, right? And how your own setup is. If you're a retail investor, the easiest is indeed to buy an emerging market ETF. Now, the interesting thing is I think most people's default mode when they look at emerging markets is always to look at the equities and to buy the equities. But the opportunities on the debt side are very often better. And look at 2022 as an example. In 2022, you actually made money on Brazilian bonds, on Chilean bonds, on Indian bonds, on Indonesian bonds. Now, imagine if I'd come to see you, if we'd had this chat in early 22, and I had said, hey guys, in 22, China's going to lock down even harder than everybody expects, and the Fed's going to and Chinese economy is going to tank. In spite of this, the Fed's going to raise interest rates 400 basis points. So the U.S. dollar is going to rise, and bond market's going to go down. U.S. Treasuries are going to go down 15%, and U.S. equities are going to go down 15%. So if I were you, I'd buy a bunch of Brazilian bonds and Indian bonds. You would have looked at me and you said, "You're an imbecile. Don't you know that when China does badly, when the U.S. dollar goes up, when the Fed tightens, when you have a bear market, emerging markets get smoked. They don't rise, but of course they rose, and especially emerging market bonds did well. And now actually emerging market bonds for the first time in my career are more negatively correlated to Western equities than developed market bonds. And I think that's partly because of the differences in policies in emerging markets than developed markets. There's a lot of reasons, but so I would say, look at bonds as well. Don't just have the blindfold on and just look at equities. There's very attractive things happening in bonds. So point number one. Point number two, I think if you're a retail investor, an ETF is probably the best way to play it. You get diversification in one go, and sure, you can buy country ETFs if and where they're available. I do think Mexico is an interesting one. Indonesia might be too small for an ETF per se, or you find a good money manager. Whether by region, like obviously we're specialized on Asia, but you can find some great guys specialized on Latin America. I think it's hard to be a pan-emerging market investor. So you're probably better off finding a specialist for LATAM, a specialist for Asia, maybe a specialist for Middle East and Africa. It's just hard to cover everything, or you must really like airplanes.
Who doesn't? Yeah. What was the for the experience for the retailer? So how can they avoid, for example, mistakes in trading? Is there any advice you can give the audience? What was your biggest mistake, for example?
Oh, I've made so many.
Like your worst and your best trade?
I've made so many mistakes. Look, I would say the first mistake usually I think is to double down. Right, it's what Tudor Jones says. Losers average losers. When you have a losing position, either you let it run if you're really convinced, or you cut it. You can always come back to it. Especially I would say if you're a retail investor, you're not trading in massive sizes. I imagine. So you have the ability to say, you know what, this isn't going against me right now. It's both losing me money and losing me mental state, and losing, like, eating up my mind. Let's just walk away from it, and I can restudy it calmly. And if I like it again, I can always buy it again. And we now live in a world where trading costs are so low, right? You can place trades for 10, 20 euros or whatever it is, that just for the mental peace it gives you the opportunity to, okay, let's study things again. That I think too many people are too reluctant to take a loss. So many people, let their losers run and cut their winners. What Peter Lynch used to say, they cut the plants and they water the weeds. The reality is, I was very lucky and early in my career to meet Tudor Jones, and he told me, look, in my career, I don't want to name, like, it'll sound like I'm name dropping, but it really shaped my thinking. He said, look, in my career, probably 2/3 of my trades have been losing trades. And he's one of the most successful investors of all time. But I make sure that my losses are small and my winners are big. And so you have to come in with this mentality. If you come in thinking, you know what, I'm going to lose at least half of my trades are going to be losses, but I just need to control those. And when something works for me, when all the stars are aligned, when things are going my way, when I understand what's going on, things are going up for the reasons I thought it was going to go up, then you press that bet. So that would be my main advice.
So if you would have like 3 stocks, which one would you buy for the next 10 years?
For the next 10 years. I can't even think about the next 6 months.
It's a hard one, I know.
So it's a very hard one. I'll tell you why, because the way I like to construct my book is I split my book up in 6 different components. The first part of my book is the anti-fragile, the thing that's going to save my bacon when the whole world goes to pots for whatever reason.
So it's a base. It's a base, so to say. The foundations.
It's your goalkeeper in a soccer team. It's the one player who gets to play by different rules. He can use his hands, right? So first I start off with my goalkeeper, who's going to be my backstop. Now, today, I think the biggest risk is, again, is a spike in energy prices. That I think if markets are going to tank, if the rest of my portfolio is going to get crushed, it's because equities will have gone through the roof. So that's the risk I want to hedge against. So then, again, maybe that's not the risk for the next 10 years, but I think it's the risk for the next 3 years. So I don't want to answer your question over 10 years. I'm sorry. I'll look just at the next 3. So I want to own an energy stock. So after that, you pick your energy stock. If you give me just one, I'll pick Chevron. It's highly diversified. It's got a big base in the Permian, but it's big enough, liquid enough that I'm not going to get absolutely smoked in case something bad goes against it. It's doing 75 billion of share buybacks, etc. So, then my second bucket is income, an income bucket where, income buckets it is positively correlated to markets, but it still provides you some level of backstop. So, which income stock today would I own? It's hard because we've been in a rising interest rate environment. So income stocks, tend to get smoked. So let me think of it. I'll come back to this one. The third one, the third basket is defensive. Things that, sort of steady year in, year out, etc. And here I'd probably own Nestle at this point, to be honest. My fear, defensives are typically utilities, pharmaceuticals, food staples, cosmetics, that kind of thing. My big fear on utilities, on healthcare, is that now that we're in an inflationary environment, the government becomes your enemy. In an inflationary environment, the government comes and tells the utility company, you can't raise electricity price. It tells the pharmaceutical company, you can't raise your drug price. But nobody tells Nestle, you can't raise the price of a Kit Kat. Because
not yet,
but it's
not yet.
It's less likely. It's less likely than interference on this other stuff. So I don't own a staple, and that might be Nestle, that might be L'Oreal, but it's Nestle's very exposed to emerging markets, so that's perhaps a play there. Then my fourth basket is the growth stocks. Companies that are you could call them global franchises, things that are, structurally strong, etc. Now, the problem is a lot of these companies today are very richly valued. You look, Microsoft is an amazing company, and it's going to stay an amazing company. They have an amazing franchise, but you're paying 12 times sales for it. And to me, I always go back to what Scott McNealy said at Sun Microsystem back in 2000. He said, look, if you're paying 10 times sales for my stock, like I can never grow into that valuation. You reach 10 times sales. You're counting that if I have zero costs and I give all the money back to shareholders, you make your money back in 10 years. That doesn't make sense. And so I think in a structurally higher interest rate environment, all those companies that trade at very rich valuations are going to be tough. So today I'd rather own something like Alibaba or Tencent, which are also great franchises, and that are trading at much more attractive valuations. So I would own those in my growth basket. Then you've got two more baskets that you can or cannot own, but those are like that are growth sensitive to prices. So as basically more inflation hedges, can be things like real estate, can be things like commodities, etc. And the last one is the contrarian basket. And in my contrarian basket today, I'd have a lot of tourism plays. I think people are underestimating still the extent of the tourism boom we're going to see both from China and from this boom we're going to see in this crescent. When Indians start to do tourism in earnest like the Chinese did, it's going to be absolutely epic. So I don't think things like Macau casinos, things perhaps like Amadeus, the software for airline bookings, etc. So I'm already at a lot more than 3. So I apologize.
Definitely.
It's hard to build a portfolio with just 3 names.
Great overview.
But okay, if you put a gun to my head for 3 names, I'll do Nestle, Alibaba, and Chevron.
Okay. So last question. What's your take on Bitcoin?
So first, it's a very tough one because there's no real historical precedent for it. So it's hard to go back through. It's a fairly modern thing that's occurred.
Do you own some? Do you own some Bitcoin as a contrarian?
I do not. I don't own Bitcoin. And so for me, again, going into this sort of 6-bucket thing, I don't know where Bitcoin fits. It's not anti-fragile because when markets get crushed, it usually gets crushed along with it. It's a highly liquidity sensitive asset. It's quite correlated to the expansion of Fed balance sheet. So it's, for me, actually, it's a little bit like a call option on the NASDAQ. It's highly correlated to the NASDAQ when you look at its behavior. And I find it's a more volatile NASDAQ, really. And I find the NASDAQ volatile enough for my taste that I'm not sure I need something more volatile than that in my portfolio, which is why I don't own it. It's like I don't know where to place it. I also tend to think that there's an inherent contradiction in it, in that, yes, it's sort of this safe asset that that central banks can't take away from you, and all these single governments can't take away from you. But governments, as we've seen in China, can basically burn the bridges between the banking system and the Bitcoin. And if you sell your Bitcoin and you try to bring the money back into the bank, the governments can say no, the bank can't take that money. And as we've seen the more and more takeover through regulation of the banking systems by the governments, where the banks basically now have, you want to transfer 10,000 euros somewhere, you have to fill out 6 forms for the governments. That's my big concern. And we saw this in the US, right, in this banking crisis, this Silicon Valley Bank and Silvergate and First Republic. The first thing the governments came in, they said, all right, we're shutting down all the crypto business. And no more transfers to and from crypto, from Silvergate, from Silicon Valley Bank, etc. So I think the inherent contradiction is that Bitcoin becomes really successful and challenges really the government's seigniorage on currency. They'll tell the banks, you cut this off. But then Bitcoin will become a stranded asset where you can't, you have this, but you can't use it for anything. So that's my big fear, and that's why I don't own it.
Paul Tudor Jones, he owns some. What do you think about that?
Oh yeah, look, some of the smartest guys I know have obviously own them and made fortunes in them, and so I'm not claiming I'm smarter than these guys. I'm claiming I have a different process for the money I manage and for the own risk I like to take. Now, one of the guys I respect the most in this business and who's done so much for me over the years, the guy called Bill Miller, who was outperformed the S&P 500 for 15 years running, etc. He's been all over Bitcoin as well, and his point is pretty simple. Look, you put 5% of your assets in it and you forget about it, and he's done extremely well having done that. So I'm not saying it's a stupid thing at all. It's just for me I struggle to see where it fits in a portfolio construction exercise.
Thank you, Louis. I think that's it.
Yeah, that was a great interview. Thank you for your time. Yeah. Last but not least, where can people learn more about you? Where can people learn more about your investment funds?
Sure, absolutely.
Please.
Well, first, thanks a bunch for having me. I really enjoyed this conversation.
Same here.
And I'll definitely look you guys up next time I'm in Stuttgart. We have the best way to find us about us is through our website. I don't have much of a social media presence. I just don't have the time, to be honest. But we publish a lot through our website. Our website is gavekal.com. That's Gavekal. So it's my name plus my business partner Anatol Kaletsky's name. So it's gavekal.com. You go to our website and then it points you in lots of different directions. There's some free newsletters on there. There's lots of different things. That's the best place to go.
Okay, perfect. We will put it in the show notes, of course, and we would love to have you back one day.
With pleasure. Anytime.
Definitely. So much going on in emerging markets.
Yes, we have to talk.
You can bring me back in 6 months or a year, and you can make fun of how everything I said was so wrong.
Exactly. When China invaded Taiwan and so on.
Bitcoin is at 1 million.
Exactly. And sanctions over China, all your stocks are lost.
Exactly.
You can't trade them anymore.
Exactly. Tell you what,
kidding.
If in 6 months Nestle is gone, really bad things will have happened in the world.
Yeah, true story. Very, very bad. No, Louis, was a pleasure having you. I think you brought nice input. It was great picking your brain, and I think the audience will love it as well because you gave them some investment advice they never heard before. So thank you for your time. Thank you for your shared wisdom.
Thank you very much, guys. Really appreciate it.